Global markets remained uncertain over the last 24 hours as investors priced geopolitical risk, rate expectations, and sector-driven news flow. Tensions in the Middle East are not fully resolved. Iran signaled openness to negotiations, while the United States said security in the Strait of Hormuz is a red line. After these comments, oil traded with volatility and uncertainty remained in the energy market. Comments from Federal Reserve officials also moved markets. Fed members said it is too early to cut rates before inflation moves closer to target, and after this message, bond yields moved higher again while the dollar stayed strong. U.S. indices closed mixed. The S&P 500 finished flat, the Nasdaq closed negative, and the Dow Jones stayed slightly positive. Trading volume was below average, showing that investors remain cautious. In sectors, artificial intelligence and chip stocks stayed in focus. Nvidia and AMD saw selling pressure during the session, and analysts warned about profit-taking after strong gains. Data center spending remains strong, but short-term volatility is rising. In energy, Exxon and Chevron traded with volatility as oil prices moved up and down. Middle East headlines continue to drive the sector. This week, markets closely watched not only geopolitical developments but also signals from central banks. Federal Reserve officials repeated that it is too early to cut rates before inflation clearly moves toward target, and this message helped keep the dollar strong. In Europe, officials from the European Central Bank said growth remains weak, but inflation risk is not fully gone, so expectations for rate cuts stayed limited. The Bank of England said wage growth remains high and still creates inflation risk, signaling that tight policy may need to stay in place for longer. The Bank of Japan also said it will move carefully while exiting ultra-loose policy, and these comments caused volatility in the yen. This creates an important balance in the market. As long as rates do not fall quickly, the dollar stays strong, and when the dollar stays strong, gold and commodities remain under pressure, while limited liquidity makes it harder for crypto and growth stocks to build a strong trend. In mining, gold and copper stayed under pressure. A strong dollar and higher rate expectations limited demand for metals, and analysts said copper demand remains dependent on China data. In biotechnology, merger activity drew attention. Large pharmaceutical companies showed interest in smaller biotech firms, suggesting risk appetite has not disappeared, but the overall sector remained weak. In periods like this, investor psychology becomes more important than price movement. During uncertain markets, investors struggle to find direction, and instead of strong trends, the market shows sharp moves up and down. A similar period was seen in 2018. At that time, rising rates, trade tensions, and geopolitical risks kept markets in a long, sideways, and volatile phase. In these environments, large funds usually prefer to wait, while smaller investors often make mistakes trying to find direction. Low volume and fast rotation between sectors are common signs of an indecisive market. The current situation looks similar. The market does not want to take full risk, but it also does not want to fully exit. Because of that, without a change in the news flow, a strong trend is difficult to build. Crypto markets also showed a cautious tone. Bitcoin traded in a narrow range, and most of the volume stayed in Bitcoin, while Ethereum failed to attract strong buying and altcoins remained weak. Total crypto market cap stayed flat, and ETF flows were reported as limited. Uncertainty around stablecoin and ETF regulation in the United States continues to prevent a strong trend in crypto. Overall, the market still has no clear direction. As long as energy prices, rate expectations, and geopolitical risk stay uncertain, both equities and crypto are expected to remain volatile and cautious. We talk markets, not noise. D&D.